Welcome back to the weekly market analysis for the week ending October 6th, 2023. Before we get started, I want to remind you that you should hit the like button and subscribe to the channel if you enjoy the content. And you can also find me on Twitter at Mr. J. Thomason. And on Substack, you can follow my weekly newsletter at befinanciallyfree.substack.com. The links to both my Twitter and my Substack are in the description of the video below. If you subscribe to my newsletter, you get the first half for free, and you can check out a free trial for the premium section, a 7-day trial, if that is something you're interested in. And as we get into the markets, last week's video, I said basically that you should stand on the sidelines until things clear up. And I think that that was prescient advice because if you look at the markets on a weekly basis, on the S&P 500, if you look, we're only up about 16 points on the week, and there was substantial volatility throughout the week, as you can see on the chart here. And so last Friday we closed, we were down 12 points, closing at 43.25 and 50 cents to the tick, and we had a kind of a downside reversal day on Monday, big down day on Tuesday, Wednesday, down day that ended up reversing to the upside pretty hard. Friday, down day that reversed to the upside pretty hard. And then today, also big down day at the beginning and reversed to the upside. So if we take a look at the S&P on a 1 minute chart, excuse me for a second. Let me get rid of a couple of these things here. It's kind of interesting. I'm gonna just, I'm just gonna show you something that happened earlier. So today's big news was the non-farm payrolls report, and this is part of the reason all the payrolls, ISM numbers, and the like this week were part of the reason why the caution last week was to stand to the side and just kind of wait for clarity, because there was a lot of uncertainty about what was going to be coming with the economic data, if that was going to show sticky inflation, or if the job numbers were going to come off, or deflation, or whatever. And I want to point out a couple of tweets of mine. Let me just go really quickly, find a couple of things. Here we go. Oh, so I tweeted this last night. I said everyone is expecting 170K tomorrow and massive revisions downward to previous releases. And this is kind of the story that I saw all week as we went through the JOLTS data on Tuesday and the ADP numbers on Wednesday and the initial claims yesterday, which kind of were seesawing back and forth. And the noise and commentary that I heard over the week was that we would get, at or below 170K, and that we would see the last 6 months revised downward. And what I didn't hear anybody talking about was how could the markets react if none of those things come to pass, if we're over 170 and if there's no downside revisions. And when it came out, if you didn't already see the news release, I don't have the news release up on my screen, but basically non-farm payrolls were more than double higher, or were about double higher for the month of September, so twice the expectation, and there were 2 previous months that were revised higher. So not only was the jobs number higher for this last month than expected, it was like even some of the previous months were not revised downward, but they were actually revised upward. And so on the news, we just saw a minus 33.5 candle on the S&P. The Nasdaq got a minus 154 candle. That was in 1 minute. Those downside targets happened, but shortly after that, at 5:37, so this is just a few minutes after that price action took place. So that would be right here with the Nasdaq at that particular time down, 37, with the Nasdaq down 168 points. I tweeted or not down 168 points, but 168 points lower than where it was a few minutes prior to that. I tweeted saying, I bet markets close up today, and I'm proud to say that they were, and they were up pretty big. NASDAQ up 250 points, S&P up over 50 points on the day. And so all that is to say, I think that I've had a pretty good read on the markets the last few days, and I think this is the point where I could say, where last week the story was stay out on the sidelines until there's clarity. This week it's proceed cautiously. And there's a couple of reasons for that. And last week I tried to outline for you a couple of reasons to be bullish and a couple of reasons to be bearish. So what I want to walk through with you now is why I think it's okay for you to proceed cautiously to the long side. So if we just start with the technical picture on the S&P 500, this ascending trend line from the bottom, I've been kind of adjusting it periodically here and there depending on what the market is showing that it's respecting. And I found that based on the price action of the last few days, if you set the trend line in this way, then it looks like it turns out pretty good, and you could even adjust it to be kind of more like that, and that still works. It still has the same effect. Basically, this is what the market is respecting as far as the prevailing trend on the underside. Now on the top side, our trend line is connecting the August 1st highs with September 1st and then September 15th, and that's a pretty well-defined downtrend line. And so we're kind of the reason why I say I think you can proceed cautiously for now is that over the next week or so, there is enough room for price to come up back close to 4,500, or somewhere between 4,450 and 4,500 would be, I think, doable, even just as a bounce. Now, I think my bias, I'll just start off with this, my bias is that price is actually going to come up and either get to pretty close to its highs from July, or it might even surpass them and go towards closer to the all-time high, somewhere up in that range. But I obviously am not married to that view, and I'm willing to change if need be. And so what we're seeing here is we have technically some space to move to the upside. It's not only that we have the underside trend line support, we also have support kind of, let me put the line here so you can kind of see where we're at. We've kind of got support approximately right about there. Obviously back in early 2023, this level isn't perfect, but no level is. You just kind of have to tinker with it. But basically, this is the level that the market appears to be respecting, and it coincided with the underside trendline resistance. And so we've gotten a couple of instances here just today and yesterday and on Wednesday where price had been trying to trade down, and it couldn't. And the reversal today to the upside and the performance to the upside has me more and more convinced that at least in the near term, price is going to continue up, or going to resume to the upside. And so at least over the next week, I'm pretty bullish. So that's one thing I wanted to point out on there from a technical standpoint. Another thing I wanted to show you is I typically look at this metric. It's the S&P 500 stocks above 50-day moving average, and I shared about this last week. That last week we were, so at the close of last week we were hovering at 1471, and I said I was watching for if this were going to dip below 10, and it did. And basically that spot, if you bought the S&P 500 at the close of Tuesday's price action, then you're up over the last on Wednesday, Thursday, and Friday, despite all of that volatility, and it makes sense to me, because if the stocks have been sold so hard, it's kind of hard for them to go much further down if they've already been sold down like that. So that you should expect a bounce when that happens. And this is, I mean, just going back across the time series, anytime you see anytime you see this metric go below that 10 line, then price is almost guaranteed to reverse to the upside, at least on a bounce, if not to mark the durable bottom of the price move. And so obviously that has transpired. And then another thing I want to just point out is, if I put up my some of my indicators that I use, there's a lot of things like once you start seeing the green triangles pointing up, I think I mentioned this last year, the signals aren't always great on the upside, or as far as topping signals, but they are pretty good at marking bottoms that are going to see bounces. And so we've gotten 2 of those recently, and usually the further that price goes and the more that you stack those, the greater the likelihood of a very, very fierce reversal comes into play. And so to me, that signal lines up as well. And then you see my tide indicator that I've talked about a lot on this channel. That technically, though the lines are converging, we are still in bullish tide, and so that's something that I think we all need to take into consideration. That this is the time when people are most fearful about buying, and yet, as days like today show, we can have pretty fierce rallies to the upside. Now, again, this does not mean that price is guaranteed to go higher. I just think that the probabilities of price going higher are much greater from here than going lower. And so I think that that's reason to be bullish also. And then I think that we're seeing a couple of reversal signals on the US dollar. We've had, today was a big time reversal day. This is the kind of thing that is like a news failure event, because the dollar has been so bullish, and today on the payrolls number, the dollar was up real big, and it ended up closing in the red. And so I think that the dollar is going to continue to cool off, which obviously means that, as far as DXY goes, this means that you're going to get, probably strength in the euro, maybe in the pound, maybe in the yen. Definitely in the euro, though, that's got more than 50% of the DXY weighting in it. And the same thing on yields, although not so much. We got a big move up, and this would have been a better signal if we had closed down. But I actually, there are some who think that price is going to come off here, and it might. If I'm going to be bullish equities for the next week, then I guess I have to believe that the yields will come off. But also, the yield on the 10-year was up 1.82%. And so, like closing at 4.8, it's the highest daily close in like 18 years now, or something like that, or 17 years. But despite that, like I said, the Nasdaq's up 250 points, S&P's up 50 points, and it could have been more. So I feel like this could go up a little bit higher, but I would like, because I think Wednesday was an important day, because we got that upside move, and then it reversed and actually closed red. And so for me, that was kind of the signal that maybe that might be the start of the topping or the reversing that's going to be coming on the 10-year. But all I would say is that you'll want to be careful here and watch for yields to maybe come off a little bit. But it also could go, it could go a lot higher. And I want to say on the 10-year, like one of the things that I talk about in my newsletter, and that I've talked about for months now, is the flows into bonds. Like one of the things that I track is the equity and bond fund flows. And one of the things that I've been kind of commentating on all year is how basically for the entirety of 2023, bond fund flows have been positive. In other words, people have been buying like TLT and IEF and IEI and a lot of those ETFs all year. And I was worried about what might happen if those positions start to unwind. And now, actually, it turns out over the last 4 weeks or so, 3 or 4 weeks, it's the first time in a long time that we've actually seen negative, or I guess negative flows, outflows from those bond-related funds. in 2023, and I think that that's an important that's something important, because it means that investors who have been on the wrong side of that trade, I mean, let's take a look at TLT. Investors who have been on the wrong side of this forever, well, not forever, but just, especially over the last year and a half or 2 years, it looks like they're finally starting to capitulate to the downside. So in other words, people who, if you think about what was happening in 2022, like, we had our 2 negative quarters of GDP, which people were talking about recession. So everyone was allegedly piling into the bond trade then. We had the inverted yield curve. People piled into the bond trade then. We had all the scares about, recession in late 2022 and at the start of 2023. People piling into the bonds, into TLT and the bond trade, thinking there's going to be a recession. And they've been wrong all the way down. And now I feel like they're finally capitulating out of that position right around the time where I actually believe that it's going to be time soon. I'm not saying now. I think it'll be maybe another week. No, not week. I want to say maybe we'll put it on like 2 to 4 weeks, just according to my own analysis and how those things work. So in any case, my point is be careful, because the yields on not just the 10-year, but long bonds and even kind of like mid-duration bonds, their yields could still go quite a bit higher. So I've got really no bead on the direction here. I think a lot of it will depend too on what happens next week. We've got PPI and CPI coming up, and so that's something you'll want to watch for. One of the things that's a pretty big deal here, I think this is the beginning of stabilization and then potentially reversal in gold. We didn't quite get down to the level that I thought we would. We got the low today was at 1810. But this, again, very similar to the dollar. We've got all the makings here of a reversal, because you've got the on a very strong piece of economic data, which gold, like if you're curious about like how gold works and why gold's price hasn't made new all-time highs like a lot of people thought it would, then you should go to my Twitter and find my my thread on gold, or my long tweet on gold. You just search Mr. J. Thomason and gold to find that. But one of the things that gold relies on is deflation, or just in general like weakness in growth, and so today on a strong jobs number, which shows that growth is still really strong, to see gold sell off and then to see it rebound and come up and close actually pretty up and strongly towards its highs on the end of the day is actually a really bullish sign. And so what's actually really funny too is like ignore like the far left side of this chart, but if you just look at the way that the gold chart looks and then look at the dollar chart from before this current run up, and you kind of look at the chart coming down, kind of making these like lower highs and kind of, and then you get this little puke, and then that's when the reversal takes place. And I'm not saying that it's like, I'm not trying to look at fractals and try to line up fractals. I'm just saying that I feel like this could be one of those situations where we are kind of like consolidating. We got a big move down. People capitulated. Everyone is bearish on gold now, and I think this is the opportunity now to potentially buy. I can't say with any certainty like that what's going to happen through the end of the year. I think my base case is that we'll get an all-time high next year on the other side of recession, or towards the other side of recession. But that doesn't mean that we couldn't, start trading up through the rest of the year. I mean, you could still get gold, back up towards like 1950, 1975 before the end of the year. There's plenty of time to do that. So it wouldn't be at all surprised to see that, or surprising to me to see that. So just be aware of that. And then finally, we got the reversal on crude oil. I was a week early, but man, has this been a good trade. I actually called that trade out on Tuesday the 19th and Wednesday the 20th. And then of course, like price went against me for a little bit. But if you go from the original position, crude oil is down 8%. And so it was a good trade. The positioning lined up. That we got all the bullish prints that we could ask for, and then price still ended up reversing. And so this has been a pretty fierce pullback. And I think it's hard to really know. Like the positioning data is only reflective up till Tuesday, and I'm a little sad about that because the positioning data won't show like any positioning changes as that happen as a result of these these washdowns in the crude oil price. We dropped over 5%, nearly 6% on Wednesday alone, and so that's something to watch out for. My guess is that this correction is fierce and deep, but that it's actually going to go back to the upside. Because even in 2021 and 2022, if you look at kind of what happened on crude oil, you'd get these rises and then some sharp pullbacks, and then it would just keep going. So that's what I would expect to see in the coming weeks, but I don't have a timetable. I don't have anything. I don't have an x-axis for that. Any sort of date target on that. The VIX spiked to above 20 this week. Usually that's necessary on a fear move to get some catharsis in the markets, and ever since then the VIX has come back down. So it'll be interesting to see what happens next week. Will the volatility stay up, or will it come off again? Bond volatility spiked this week over the last week, and so it's at a higher level than it's been in some time. So we got to watch that, and the same thing with credit spreads, which have spiked pretty tremendously over the last few weeks. Just in the last, the last 2.5 weeks, the credit spreads have widened to almost 17%. So that's concerning. In just a week and a half's time, or 2.5 weeks, was that? A week and a half, 2.5 weeks time, we've made up about half the difference to the high risk threshold, which is at about the 5 level. That's where things start getting a little dicey. And so that's going to be something you're going to want to watch out for. The yield curve continues to steepen. Obviously, it's been a bear steepening for some time, and this is the reason why I think it's going to be time to buy bonds in the near term. Because my study shows that once you get a bullish tide cross after an inversion, usually within a month after is the appropriate time to buy the longer duration bonds. And usually within 3.5 to 6 months is when you actually get the beginning of the recession. And obviously you always have to put these trades on ahead of those events, because once the recession is actually here, it'll already be priced in, or pricing in, or asset markets will have already basically made the most of that move. So I think, let's see, we talk about Bitcoin. Bitcoin is surviving above its tide line, so it doesn't look like there's any sort of impending downside action anytime soon. But of course, the positioning is pretty heavy in Bitcoin right now to the upside, or on the long side. And so that's something that kind of makes it hard for price to stay up. But of course, Bitcoin's going to do what Bitcoin's going to do. So anyway, I think that's where we'll leave it. So in the near term, I think that it's going to be bullish over the next week. We'll see what happens. The one thing I forgot to mention, as far as this goes, I don't have the chart up, so I apologize. But basically, there has been no change in the sentiment readings. They're actually just slightly more bearish in terms of the sentiment. And so it'll be interesting to see what happens next week, especially after this big update, because the sentiment numbers come out on Thursdays. So that'll be interesting to watch for. But in any case, that's another reason why I suspect the upside price action can continue, because I think people are still a little too bearish. Anyway, I'll leave it there for this week. I hope you guys have a great weekend, and I'll see you guys next time.